Volatility is back and stocks are going crazy. I guess no more easy money. In the last few weeks, S&P dropped around 3% from the all-time highs, and Nasdaq at one point was down almost 12% before it made this huge reversal Friday afternoon. Most pain came in high beta momentum stocks like Tesla, Square, and Roku. Cathie Wood-led ARK Invest ETFs are down huge. Her signature Ark ETF is now down 26% from the highs. So, what next? Hey guys, welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, and everything money. It's been an epic 2021 so far. The so-called rotation continues from growth into value stocks. Tech sell-off has accelerated, and 2020 laggards like energy and finance are having a fantastic year so far. With the recent noise around yield, inflation, and interest rates, high beta growth names are getting creamed. Some of these names are building blocks for ARK ETFs. ARK is one of my core holdings. In this video, I want to share my opinion on what next for ARK and how am I managing this dip in one of the best ETFs from 2020. Spoiler alert, I just bought this dip and will continue to add if these drop further. I am following a plan which I'll share later in this video. In 2020, ARK returned 152% compared to 47% for QQQ and 44% for XLK. In the last 5 years, ARK has returned 52% on an average. Indeed, the performance is comparable to leverage ETFs like TQQQ. Take a look at this video for more information. With this kind of performance, I would rather have ARK and underlying stocks take a breather as opposed to just going up in a straight line. It is healthy for the ETF and the broader market. The fact that this is a rotation as opposed to selling the overall market is a good thing, a sign of a broadening bull market. My friend Cathie will agree.
So this rotation is healthy, a good correction, shakeout is healthy, great time to average in to strategies you like. Makes me feel good from a couple of points of view. One, the bull market has broadened out.
As of last week, ARK Innovation ETF is down 26%. If ARK has been in your watch list, this is an awesome time to start a new position. Ignore the short-term noise and invest in innovation. A quick reminder, you want to invest in ARK for a few reasons. Number one, you believe in the innovation story. You believe in EVs, blockchain, Bitcoin, artificial intelligence, DNA sequencing, and other innovations that are brewing around us. Number two, you understand that investing in ARK means investing in companies that may not be profitable in the short term, may be considered overvalued, and will be extremely volatile. And number three, you are focusing on exponential growth, technologies and companies that are shaping the future. And if you believe in all of these points, then there is no other tool out there better than ARK. Her team is focused on innovation and trying to find the next Amazon and Googles of the world. You don't want to invest in ARK if your investing style means predictability, valuation, dividend, companies with a cash balance. This is not ARK. You can tell I'm a believer, but I'm also a realist. And things can change really fast. For now, I strongly believe ARK should be in every portfolio. Of course, with every investment comes a certain level of risks. And as an investor, you should be aware of that. Having said that, I do believe that as a long-term investor, everything that we are hearing about ARK these days is noise, and this dip is a legit buying opportunity. There are haters out there, and they have some compelling arguments. Let's start with yield and interest rate argument. See, bonds compete with stocks as an investment, and bonds are starting to become more attractive. Tech names are more vulnerable to a pullback in a high interest rate environment because these stocks don't tend to offer a yield and operate in areas considered overvalued. As interest rate goes up, value of future cash flows for these growth companies go down. Investors hate that and suddenly like the predictability of bonds. Look up discounted cash flow model if you need more information. Also, check this video out. Kathy has stated that she's not too concerned about yields and is ready to double down on her high conviction stocks if they drop. Indeed, she recently added to Tesla, Palantir, and Zoom while trimming more stable big tech names like Apple, Amazon, and Google. Which brings me to the next argument, liquidity. ARK invests in small cap and high beta, high growth stocks. As tech has declined, these stocks have come under pressure. Critics argue market declines and outflows could create a negative effect across ARK's portfolio, which could potentially cause some of its less liquid small cap holdings to trade sharply lower. Both Kathy and Tom, the COO, have defended ARK by stating that these worries are overblown. ARK is only invested 15% in stocks with market cap below $5 billion. Also, most of the risks around market activities and flows is managed by market makers or authorized participants as opposed to Kathy and her team, who is solely focused on investing. They have a paper on this topic. We'll link in the description.
Even though the markets were very volatile and the number of shares traded exploded, the volumes exploded, the ETF industry and the ETF infrastructure handled it beautifully. And as a portfolio manager, I know the difference between an ETF wrapper and a mutual fund wrapper. A portfolio manager in the ETF space does not have to worry about flows. It's the market makers, the authorized participants. It is, the ETF ecosystem that is accommodating the activity. So I'm just making investment decisions.
As they say, things are fine until they're not fine. Only time will tell if interest rates, liquidity, or some other compliance or SEC related argument lead to ARK's demise. And for these reasons, you should think about ARK from a portfolio perspective as opposed to going 100% in it. Personally, I like to keep a balanced portfolio, a mix of stocks and ETFs that offer stability, value, dividend, and growth. It is more tilted towards growth. Currently, I'm at 20% with ARK ETFs. I think somewhere between 15 to 25% is a good allocation. These ETFs can offer exponential growth for your portfolio, but can also come with increased volatility. I typically add new money in the market when NASDAQ falls 10%, 20%, and 30% from all-time highs. Last week, at one point, NASDAQ was down almost 12%, with ARK ETFs down 26%. I ended up buying this dip. If ARK drops further, I may raise my ARK portfolio allocation to 25% and continue buying this dip. They are on sale. Unless you don't believe in innovation, there is no reason to not buy this dip. As a long-term investor, this will bring down your dollar cost average. Once the noise settles, you will be happy you bought these at 25 to 30% discount. Hope this helps. Are you buying the dip? Let me know in the comments. Like, subscribe. Until next time, peace.